All right, we're back. Happy Sunday. A little quick update, as I always say. We will see how quick it actually is. I just wanted to go through and actually talk through positions again. If you don't know who I am, I'm Ben Collins. I'm a CFA charter holder, Chief Investment Officer at Options Autopilot, which is an automated options trading platform. And also wanted to go over, in this scenario, it's not all fun and games. It's not always profits, and it's not like you're always making new highs. So pulled back a little bit, wanted to go over what is not working, what is, and how things can kind of go against you, and how you want to be aware of that. So if you appreciate that transparency, make sure to subscribe. I'm giving you updates, kind of showing you what I'm doing along the way, both with automated options trading and then individual positions. So let's kind of jump right into it. So right here we got my TastyTrade up at the moment, and we can kind of just go over the general market. If you recall, I'm kind of shooting myself in the foot by putting on a manual 111 on the call side, which is destroying me, as you can see, down almost $2,000. On the automated put side, which I'm just running through Options Autopilot, I am up $525. So had I not been messing with the call side, which I also had a second one on as well, just because I'm leaning long on some other positions, I would be up significantly more than I am right now. You can kind of see year-to-date historical. I think my last video I was up around $30,000 year-to-date. You can see it's pulled back now to $26,154. Again, that's kind of the gross number, excluding the commissions, which is actually significant, but just to make it easy. So we pulled back around $4,000 to $5,000, maybe $4,500. I kind of want to go over why and what I'm doing or not doing in the meantime. For the broader market, S&P 500, I basically wanted to just go over my thoughts here. If you recall, I've kind of switched. I'm going to be switching out of ES trades, and I'm doing a lot more MES trades. I only have one on that contract, but you can see that I have a lot more on these contracts. And what my thought process is, I'm taking my profit for the year and kind of just de-risking myself and only using my profit year to date to trade with. So I'm pulling money out of this account, and I'm basically going to just be utilizing the profit. So even though I'll have, well, right now I have about 50,000, I think I had around 70, even though I'm going to be trading with basically just that $26,000 or $24,000. So if you look at this, that would be approximately 50% of my capital at risk, and it would be extremely difficult for me to actually lose that in any given time frame. And the reason I'm kind of doing that is just going higher frequency, smaller dollar amount by using MES, which is the micro contract, versus the mini contract of ES. So I can effectively put on 30 trades at a time, and at any given point, I would pretty much never give up. I shouldn't say never, but I'd be very unlikely to give up the profit that I've made on the ES trades at this point, just because any individual MES position, if it got stopped out, I'm on average probably pulling in $40 to $60 a trade, just depending on what it is. And then if I had one go against me, I'd be losing about $100. So, I mean, I'd have to have, so even if all 30 trades theoretically went against me all at once, and my hope is that some of those would finish in the bear trap, so I'd actually make that money back almost, then I would be losing $3,000, right? So it's not significant, and I'm partially doing it as an experiment, because if this goes well, what I'll probably do is increase the contract, because right now I'm just doing 111s, but I would probably just up the contract to still keep the same structure, but then do 2 contracts each or whatever it is. So maybe I'm just upping my potential profit to, I don't know, $120 to $150 profit target, but then I could lose $300 to $400. So again, you got to be careful there, because then you start to get into, losing decent amounts of money if all of the money against you. That's just my thought process. I mean, we're kind of near all-time highs. On the last video covered, valuation levels are pretty stretched. Doesn't mean they can't get more stretched. That's the thing about the market. It's going to do what it wants to do. It doesn't really matter your opinion. And so, we can see it's basically just making a new high, I think, on Friday. So potential to continue. I'm a bit cautious, but I think it just makes sense to keep doing the strategy, leave the automation on, because like I've mentioned before, even if it pulls back and starts to come down, like since I'm doing it at such a higher frequency, just every day and every week, it's going to be doing more of these. And so even as it falls and VIX spikes, I'm just going to be putting on more positions. So it should average it out and kind of reduce my risk from that standpoint. And that's also why I'm not really doing any zero DTE, because at a certain point, this becomes zero DTE, basically, because you have each position or one of the positions expiring or a couple at each day. It just takes a little bit longer to get on there. So that's my thought process there. Crude oil's kind of humming along. I don't know what's going to happen really with crude. We have some significant changes in the Intel and kind of the SOFI outlook, I would say. But let's see. I guess we don't really have crude oil up here anymore. It's kind of been a little volatile as of late. You can see it's pulled back. So clearly, maybe the market is kind of anticipating. Obviously, we're at the end of the driving season. We're also getting some not as great numbers, both on the inflation and the job market standpoint. So maybe the market is thinking demand will be a little bit softer than expected. So in general, my position should be okay, but it's possible that I get stopped out. It kind of jumps around because some of the contracts are volatile. But you can see my 50, my 56, and then my 49 is my short put there. I mean, it would have to collapse significantly to get down to 49. But again, anything is possible. It's at 60, right? So it'd have to come down literally $11 and make a new low. I guess if we use the ETF, let's see if we can get a little bit better historical picture here. But this is not necessarily the price of crude oil, but we can see it has been down there, and then obviously it's rallied. This is from 2020, right, where it just collapsed. But it's definitely got some good demand here. So I think we'll be okay. I'm just going to leave crude oil running automation-wise as it is, and then just go from there. Bonds, same thing. I would think if things are pulling back, the market's getting a little bit concerned, you would think that the rates are going to kind of decline, and they kind of have. You can see a little bit of rally here in the bonds. So that means prices are going up, interest rates are going down. I think that'll probably continue, or at least will hold in here. Again, we can look at like TLT and get a better context of where this is in the grand scheme of the graph. So you can kind of see. I mean, I got a lot of old lines in here, but I would say that this is kind of a bottom and start of maybe a new uptrend. Never know. But like I said, I think this is a good time to just be doing these strategies. They should hopefully have lower correlation to the overall equity markets. So it's kind of status quo there. Bitcoin obviously making a new high, so the put spread strategy is working. I actually might increase that. I only have 3 positions currently allowed on options autopilot, so I was just keeping it capped at, I think it's $3,000, yeah, or $3,500. So as of right now, I'm utilizing this. I guess we got to change this because technically this is $405 on 3,000, which is what is that, 12% basically. But yeah, I probably will increase this maybe to 5,000, so it'll at least do a little bit more. But you can kind of just see this is fairly good example of just what the automation can do. I literally haven't touched it, I don't think, since near the beginning of the year. You can see 85% win rate, and as a reminder, I'm kind of selling, I think, the 11 or 12 delta, so it's pretty close to that 26, almost 27 days average in the trade. Average profit $20 per trade. So I think that we'll just keep going. I think there's a tailwind behind crypto in general. I'm not going to say a crypto bull or anything like that, but I just think both the administration and all the kind of institutions view that as, what is going on here? View that as a way to make money. So I think that that trend is likely to continue and more assets will flow into it. I'll pull up gold once this finally stops being stupid, because I still haven't re-engaged the gold trade, and I've been a little surprised at just how strong it's been, but I've seen some interesting videos. If anyone follows, Andre Jick, he has talked a little bit about what supposedly, the U.S.'s strategy, or at least how it's perceived from Russia and China's viewpoint. To a certain degree, it actually makes sense. I kind of think that that's true. It's basically like we're almost trying to not devalue the dollar, but we're basically trying to go into these other asset classes as a safeguard, or they are trying to go into it as a safeguard against dollar kind of losing its reserve status and all these types of things. Kind of makes sense. It is kind of the original Bitcoin kind of diversifier. I think it's up so much that if we get some type of pullback, it could be a liquidity area for people to kind of go to. But in general, it doesn't necessarily show any signs of stopping. I mean, I would say maybe there's a support line there. If it's going to pull back, I would potentially be fine starting up the put spread strategy again, or I was doing a broken wing butterfly and maybe try and put the tent right around this level. So in case it did pull back, maybe I'd have a better chance of earning a higher profit there. Hard to borrow. I guess people are shorting it. I don't know. Maybe that's why it's getting pushed up. But yeah, so that's pretty much the story here. My XRP, whatever, that was just kind of a throw some money in it as a part of a diversifier. It's not actually making any money at the moment. The chart still has yet to break out. It's kind of interesting to me. Again, kind of get the story. It's more of like, okay, that's a convex potential payoff if it actually works out, right? But you can just see I drew this line a long time ago. Still can't seem to break back above it. Once it does, I might add to it, because that's probably going to be a signal of maybe a resumed trend, but so far nothing at this point. So the big changes here, you can see we've kind of pulled back both in Intel and SOFI and RIVN. So for RIVN, I've pretty much given up all gain for the year, which is extremely annoying. To a certain degree, it kind of makes sense. They pretty much hit their delivery target, but I don't think it was as positive, going forward. And I think that they're kind of the market is wondering, how are they going to actually be producing enough cars to do what they need. So on one hand, that's a good problem to have, but then you don't have profitability because you're not doing as much, sales because you can't. So my hope was that this was going to be the start of then a pretty big breakout, but now it's just pulled back and it's continued to fall. So I actually cut my position down. So if anyone recalls, I had 10 contracts on. I added 4 contracts when it was breaking out. Because my rule is, not adding unless I'm up money. So I had gotten up a little bit of money, added 4 contracts a little prematurely. Then it started to work out more. Now it's fully pulled back. And so since it's now pulled back from before, and I actually am down money on the position, I'm not down money on the year because I was actually up on it a little bit beforehand. It's just, in my mind, when you have something that's going in your favor and then it completely pulls back, I don't think it makes sense to have your full position size on still and fully cut it. So I cut my position down by 4 contracts. So I got rid of those extra ones I had added. Now I'm back down to 10. I will probably, I'm giving it a little bit of leeway because I do have leaps, right? I mean, I don't get why on Tasty these like move around. I don't even touch them, but so if it basically doesn't hold this level and it breaks below, I'm probably just going to exit my whole position and just wait, because clearly the market's disagreeing with, I guess, myself, or the trend being up higher, or not having as much optimism on the stock. So I don't necessarily want to fight that tape, or I might just cut my position down and then if it rallies back, I'll add it back in. SOFI, that's another one that again, all the stuff that was working, either people are taking profits or it's kind of reversed. So you can see there's a pretty hard reversal. We've had a pretty huge rally, of course, since April, but I would say from July to here is kind of like the actual new breakout. So it did get to almost 31 pretty quickly, but now it's fully pulled back, kind of broken this uptrend, which is probably the more concerning thing. I think if it doesn't hold either the kind of psychological level of 25 or kind of the recent, I shouldn't say recent, but previous kind of IPO highs that this is at 24 something, maybe 24.50. I probably am going to have to lighten things up a little bit more. What I have been doing is selling puts for the most part is why my effective delta is so high. Because my actual call spread, if you recall, I basically took a lot of the profits and put it into a call spread, just assuming it would continue, right? But this is where it doesn't always work. So your long ones start to go against you, and the market is still going higher, and I'm leaning short on the market. So it's kind of getting that, it's called basis risk, basically. So the correlation is not holding up, right? My longs are not going up, and my shorts are not going down. So it's actually going the reverse way. My longs are going down, and then my kind of little short against the market is not hedging anything. It's actually hurting me, and that can happen. So you got to be aware of that. So basically, this call spread, I was thinking, obviously, if it's at 31 already, going from 35 to 40 seems like a no-brainer. Then it promptly pulls back. I did have some 26 strike short puts right when it was at about 26. I closed those down. And then I ended up opening some short puts farther down. So currently, I kind of have a staggered strike of short puts. So my closest ones now are 23 and 5, and then obviously 22 is where I mostly have them, and then 21. So obviously, this is a little bit not nerve-wracking because, like I said, even if I get a sign on all these, I think it could still then pull back to, I don't know, $15, and then I'd still be break even, which I think would be a massive, crazy bad move. But anything's possible with SOFI. Sometimes the market really dislikes it for some reason. It's been in favor, and now maybe it'll be out of favor again. So it's definitely one that can move around a lot. So that's why you can get a lot of premium in puts. I think long term, I still think it's good company. I noticed just in a brief search on their earnings, they basically only have about $1 billion in AUM of wealth management or kind of assets from that standpoint. Most of their money is made in lending. I'm probably biased because currently I've been involved in kind of wealth management M&A stuff, but I think that they would significantly benefit from actually having a broker dealer / wealth management acquisition. Just because that kind of margin for the business is pretty high. So if we saw any kind of news like they acquired, I don't know, one of the bigger independent broker dealers to boost their, AUM assets by, another $1 billion, I think that'd be pretty huge and probably helpful in the long run in general, because you're also then acquiring a lot of potential customers for the business in one thing, and then you're also making money on the AUM. So that's just my thought. I've never seen anybody kind of talk about that. Maybe they have. But I still am sticking with it, but I'm a little bit cautious. If it pulls back any more, I don't think I'll add to anything on the short put side. So on one hand, I'm glad that I sold my calls and then moved it into a call spread. That's helped. But obviously having the short puts, and you can see my effective delta is 1,000. So I'll end up getting hurt decently the more we come down. So I basically look at this and say 10,000 in profit. I can have it go down another approximately 9 points. So down to $15 roughly. So all the way down here. If it got there, again, I think it could be a good long-term hold, especially if rates are coming down. You have refi opportunities, more people buying houses, stuff like that. But you never know. It would suck to give up a $10,000 gain on a position, but that's kind of why I'm approaching it this way. I'm trying to have it be a little more risk managed. If some of those puts expire worthless, that should hopefully add to my profit, and then I can kind of roll that into hopefully a resumed uptrend. Last but not least, Intel has been a new pain. You can see it's obviously it had popped. I think it had gotten up to as high as up 11 or 12,000, and now it's pulled back. And I have legged into a call spread, and this is kind of a similar scenario. It's actually a bit annoying because this is one where it's actually kind of continued higher, and had I just let my leaps go, I would be up even more. But like I said, I'm following my plan. I was planning to go into the call spreads and just kind of let it go. But what I've noticed and what's been interesting is it hasn't really been gaining value the way you would expect, and that's kind of because of the skew on the options themselves. So you got to be aware of this when you're trying to do some of these things. And what I mean by that is, technically, I'm up for. Okay, my P&L open is down 120, so not the end of the world, but the actual position or the actual stock is up from when I put on both of these trades. I did it in 2 tranches. I did 20 contracts each for each spread. So I'm pretty sure I put on one spread around here and then another one around here. So you can see it's up significantly, but my actual spread is not really making money. So that's a hazard, specifically with spreads. And with something like this, you can kind of see the reason that is it's so, people must be leaning so long. It's so heavily, I guess, favored to be going up. That just means these farther out of the money calls are gaining more value than the closer at the money calls as it's kind of going up. Because technically you should see I'm long about, well, this is only showing, I guess I'm long about 5 deltas per contract. So I think that's partly because of the spread at the moment. That's pretty tight. So that should be pretty accurate. But you can kind of see I'm only now long about 194 shares equivalent. And previously I was long about 800 shares when I was just holding the leaps. So again, I'm only let's see, what is it? I don't think I have a capital requirement. It won't really show me. No. So basically my trade price is $1.25 and I have 40 on there. So basically $5,000. So I'm only risking half of my profit, and that's kind of what I had said was my plan. And these can go from $1.25 up to $5, so I can effectively make 3x my money, with it only needing to move up to $47 from 37, basically. So that was the plan there. Still sticking with that. That's still frustrating. Again, my typical plan would be to wait until I'm up money on those and then add. But if the stock pulls back a little bit more, again, it's going up not necessarily for the right reasons, in my opinion, but I'm trying to view it as a long-term position. So I will wait until I'm maybe up a little bit more, and then I will add to my call spread again. And again, the hope is that it goes by 2.5 years, it's above 47, and I have tripled my money in this. So I'd like to get up to 10,000 in position, and then I can make $30,000 off of it. But that remains to be seen how the market's going to go. So that is pretty much it. I don't think there's anything else I missed from that standpoint. Again, from the ES and the 111 kind of automations, that's been going well, humming along. My hope is that these MES ones play out the same way. I think I've been making, if I calculated it correctly, it was roughly $700 a month on about 6,000 in margin. So that's the benefit of doing these automated strategies and that position in general. So that's even through tariffs and everything. So yeah, that's pretty much it. Appreciate everybody tuning in, and hopefully this week goes well for you. And stay tuned. Make sure you subscribe. And go check out Options Autopilot if you want to see more info on that. It's in the description, and you can do a trial. And we're also doing a webinar where we've got a pretty good deal on it this Thursday. So check that out, and I will talk to everyone soon. Take care.